Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence.
It's the tale of two central banks. On one hand, we have the Fed, which had kept its rates on pause as inflation remains above target while the economy grows at a decent pace. Then we have Europe. Now, in Europe, countries like Germany and France, which are the largest of the EU, are going through political as well as economic troubles. The ECB cut rates by 25 basis points in yesterday's meeting. Good morning, JK. We had growth numbers both from the US and EU, as well as their monetary policy decisions. How are you reading all of it?
Good morning, Swaraj. So rather than tale of two central banks, I would call it tale of two economists because we had a very contrasting picture emerging from either side of Atlantic. And although headline number from both Europe and US showed below expectations, the devil was in the details. Quarter on quarter basis, both saw declines from the previous quarter. Europe from 0.4 to 0% growth. US from 3.1 to 2.3% growth. But in Europe, Germany recorded negative growth along with France. And only among the major economies, Spain has been showing good growth numbers. Now, it is significant that despite four rate cuts, Eurozone economy has not shown any positive development. Lower consumer confidence and geopolitical and political wrangles have been, haunting the Europe's growth. While at the same time, initial readings on inflation show higher from the number published by Spain, and we'll have numbers from Germany as well today. And if this trend continues, it is almost certain that Europe will be slipping into stagflation, making it much more difficult for policymakers. On the US GDP, growth was below 3.1% of Q3, but it was affected by a big drop in inventories. The drop in inventory alone reduced the GDP by 1.03%. So if you remove that factor, you have most of the other factors contributing, particularly the consumption, which contributed more than 1%, rising strongly. And so that augurs well for, the growth numbers going forward. In fact, the ongoing strength of the labor market also remains a significant factor supporting the US GDP outlook. In fact, in 2025, including low unemployment, low debt to income ratios, low debt delinquencies, and solid consumption. In fact, IMF has forecast that US GDP will grow by 2.7% in the entire year, making it the fastest growing advanced economy in this year. Now, that is a background, of two economies really, moving in different directions. The ECB meeting, of course, was also almost a non-event because 0.25% cut in the policy rate was very much expected. What the European Central Bank president would say was inviting some interest. However, again, when she did talk about whether there was no discussion about stopping interest rate cuts, that is when actually market saw some jump in the euro, but immediately that got sold off. She made the usual statements, conditions for recovery in place, and she also said if trade tensions don't escalate, export should support growth recovery, but none of that is actually guaranteed because they have very big structural issues. Germany, which is the biggest engine of growth for Europe, is really struggling with many structural and political problems. And the Europe itself is, haunted by, high inflation, energy issues, high energy prices also, and geopolitics that is not going away. Now, what we look forward to now is a very important inflation indicator from US today, the PCE core. Again, this may not give comfort to people looking for a rate cut by Fed in March because this is likely to come higher on month-on-month basis. It's 0.2%. That translates to 2.8% on a year-on-year basis, and that's up from 2.5% that was seen early in the last month. and anything about 0.21%, which translates to 2.9% year-on-year rate, that put that you see the fate of any near-term rate hike by the Fed. So we have, as you said, tail of two central banks. ECB has to cut more, notwithstanding that it is not having any impact. Fed more and more moving away from any further rate cuts. So that is how the picture is. Now, if you look at the currencies, we completed almost 1 month in 2025, but what we are seeing is USD is in an indecisive territory, fell sharply in a correction, obviously after moving very big since the November 5th election, but has recovered most of it as growth and policy divergences continue to support the greenback, apart from the tariff threats that lurk in background. There definitely is no sign of a turn in the dollar's uptrend, and there have been no reasons strong for the same. Now, we look forward to the dollar to push another leg higher in the coming month, barring any policy move to weaken it deliberately. I mean, it's very unlikely. If you look at some of the statements, I mean, even the latest statement from Trump also says there should be no move by the BRICS, either to create their own currency or even to support another currency to displace the dollar as the reserve currency. Otherwise, they are going to face a tariff up to 100%. So it's very unlikely that US immediately pushes for any weakness in the dollar. But then maybe we have to go behind the headlines and see what is driving these statements. Now, in any case, look for dollar to make another push higher this month, and this may not spare the rupee either, notwithstanding budget and RBI. So looking at the rupee itself, the rupee just hung on near its weakest level yesterday, near its 86.60, and just getting some support from the RBI selling, on the rupee not to weaken more, probably at least until the big events are coming up. So the two big events that we are looking forward to is a budget tomorrow, and the rate decision by RBI on next Friday. Budget is definitely likely to be growth oriented with some tax changes, and I mean definitely the finance minister may have to sacrifice a bit of fiscal prudence to provide more money for growth, which is slumping. So definitely it's a tough task for her, because she has been actually pushing for budget fiscal control. So that's one thing the market will be looking forward to. How much more allocation is there? How much leeway that the fiscal gives? The other one is the RBI decision next week. Market now more and more leaning towards a rate cut next week, and some are even looking at a rate cut in May as well. So possibly the government and the RBI will have to take the bite the bullet, allowing rupee to weaken. I mean, it's not going to hurt majorly unless it raises the inflation in a big way, because that supports the the export sector, as well as RBI doesn't have to spend too much of reserves, which is already depleted in a big way. And who knows, further weakness in the rupee can actually invite more longer term investments if the budget proposes growth-oriented policies. So all in all, ending the month, with a mixed note as far as the markets are concerned, but lot to look forward to starting today. The data from US and also from the events in India ahead. Thank you.
Thank you, JK. And as you mentioned, it's a tale of two economies. On one side, we have the US, which is growing quite decently. The numbers for the US growth were lower quarter on quarter. Even for the EU, it was lower quarter on quarter. But as JK mentioned, for the US, it was lower because of the fall in inventories. But the consumption, which is a very big part of the US economy, it was quite positive. And for the EU, we are having political troubles in Germany, France, and all of that, along with the structural problems which JK mentioned, energy prices, as well as many regulatory challenges, they are all causing quite a subdued growth in the EU, and that has resulted in the ECB cutting rates and even committing to that, broadly committing to that path of rate cuts. Data today, we have the PCE from the US. It's a preferred inflation gauge for the Fed. It is likely to be elevated on a month-on-month basis. An elevated number will result in a delay in any short-term rate cuts by the Fed. And dollar has broadly been trading stronger, and for rupee, which has been trading weaker, it hung on to its weakest level yesterday, maybe even possibly hanging on today, ahead of the key event, which is the budget tomorrow. So that's it from us today. Thanks for listening. Have a very good weekend. We'll see you all on Monday with a fresh round of updates.